Kiyosaki is sounding an alarm for the year 2026. He predicts that a massive economic crisis is looming, one that could potentially mark the end of the American financial empire. The event he believes will trigger this collapse is not a stock market crash or a bank run, but a localized military conflict near the Strait of Hormuz. Kiyosaki argues that a disruption in this specific Middle Eastern waterway would set off a chain reaction, accelerating a total breakdown of the U.S. economy within the next few years. It is difficult to immediately square the image of a remote naval lane with the sudden bankruptcy of the world's largest economy. Evaluating this 2026 deadline means looking past the headlines of war and focusing instead on the hidden stresses already built into the U.S. financial system. The American economy is currently operating like a financial powder keg. Decades of heavy borrowing and constant money printing have created a state of high fragility. In this scenario, a Middle Eastern conflict serves as the catalyst, the spark that sets off a massive, pre-existing buildup of economic pressure. To understand if the 2026 warning is realistic, we have to perform a structural audit of American debt and trace how a shock overseas travels directly into domestic bank accounts. This is the Strait of Hormuz. Geographically, it is a narrow bottleneck connecting the Persian Gulf to the open ocean, serving as a vital artery for the world's energy. A significant portion of the global oil supply must physically pass through this single corridor every day. If a physical disruption or blockade traps these tankers, the outward flow of global oil instantly stalls. The world's supply chains rely on this delivery being constant and uninterrupted. When supply vanishes, prices skyrocket. For the average person, this macro event quickly becomes a painful reality at the gas pump, where fuel costs can surge overnight. The shock spreads rapidly. Higher energy costs mean it becomes more expensive to transport food, run factories, and keep airlines moving. A blockade here changes the operating cost for nearly every industry on Earth, simply because the global economy is built on a foundation of energy. A sudden violent spike in the cost of goods and transport would create a severe macroeconomic reaction, a massive resurgence of consumer inflation in the United States. Controlling this type of inflation falls to the Federal Reserve, the institution tasked with maintaining the stability of the dollar. The Fed's primary tool to fight rising prices is raising interest rates, and in an energy crisis, they would be forced to keep those rates painfully high. These high rates are designed to slow down the economy by making borrowing expensive. The goal is to force consumers and businesses to stop spending. This puts immense stress on everyday functions. Mortgages become unaffordable, small businesses can't access credit for inventory, and corporate expansion stops. By fighting inflation, the central bank is forced to starve the domestic economy of the cheap money it has relied on for years. This chart shows the true vulnerability of the system. The modern U.S. economy is built on a massive pile of debt that requires low interest rates to remain manageable. Trillions in government obligations, heavily leveraged corporations, and record-high consumer credit card balances have created a system with no room for error. The breaking point occurs when the Fed's high interest rates are applied to this over-leveraged system. The cost of just paying interest on these debts begins to consume the budget. This leads to a cascade of defaults. Consumers find it impossible to manage credit card debt, and businesses that cannot refinance their loans are forced into bankruptcy. While the crisis may start at the Strait, the final collapse is driven by a debt load that becomes impossible to maintain as the central bank raises rates to fight inflation. Wealthy investors and financial institutions are already acknowledging these mathematical realities and adjusting their portfolios accordingly. We are seeing a quiet rotation of capital out of the traditional financial system and into assets that are not tied to the stability of the U.S. dollar. Investors are moving into hard assets like gold and silver, which Kiyosaki has long advocated for as a primary defense against economic instability. Large cash reserves and digital assets like Bitcoin are also being utilized as hedges against the potential depreciation of fiat currency. This shift is not based on a guess about a specific war, but on the mathematical certainty that the current financial structure is reaching its limit. Nobody can say for certain if 2026 will be the year the system breaks. Treating a prediction as a guarantee often leads to unhelpful panic. However, these warnings highlight the reality of an interconnected global economy, where a distant choke point has the power to impact your domestic bank account. This makes financial education a necessity. Understanding the mechanics of how a crisis travels is the only way to build a personal defense against systemic shocks. The people who navigate these cycles successfully are those who recognize the structural weaknesses early, allowing them to